All right, let's jump right into today's explainer on American International Group, or as we all know it, AIG. We are looking at a seriously fascinating moment in this company's history right now. Today, we're going to unpack their recent performance, dig into their incredibly robust financials from the first quarter of 2026, and talk about a massive corporate leadership shift that is completely reshaping their future. If you've been tracking the insurance sector at all, you know AIG has been on this long, multi-year journey of transformation. Well, the data we are about to look at suggests that this strategic repositioning is finally bearing some very, very lucrative fruit.
Right off the bat, I want you to think about this single, staggering number, 219%. That is the jump we saw in general insurance underwriting income for AIG in just the first quarter of 2026 alone, hitting a cool $774 million. To put that into perspective, their underwriting income didn't just grow, it literally more than tripled compared to the previous year. It's an absolute acceleration that completely blew past consensus estimates, and it really sets the stage for everything else we're going to cover today.
So, here is our game plan for today. First, we'll look at AIG's Q1 financial scorecard. Second, the big executive leadership handover. Third, we'll dive into capital returns and ratings. And finally, we will wrap up with Wall Street's current verdict.
Let's get right into it. Section 1. AIG's Q1 financial scorecard.
When we look at top-line performance, there is a very clear, undeniable profitability surge happening here. Total adjusted operating revenues advanced 5.4% year-over-year, coming in at nearly $7 billion, beating out the consensus estimates. And this was largely driven by vastly improved underwriting results across both their North America commercial and global personal segments. Basically, they benefited from lower catastrophe losses, they tightened up total expenses, and they made some really smart strategic changes in their business mix, like improving commission terms in their U.S. high-net-worth business.
Now, you all know that combined ratio is basically the ultimate pulse check for an insurer's operational health, right? It's that delicate tightrope between incurred losses and earned premium. Well, AIG's execution on this front is exactly what we need to focus on next.
AIG absolutely nailed this metric. Their general insurance combined ratio drops down to a highly profitable 87.3%. Guys, that is a massive 850 basis point improvement over the prior year. They are underwriting with serious discipline right now. And alongside this, their adjusted return on equity hit 10.9%. That's a 450 basis point jump year over year, which really highlights their enhanced profitability and capital efficiency.
Okay, moving on to Section 2, the executive leadership handover. So what we have here is a very precise multi-step leadership handover from current chairman and CEO Peter Zaffino over to former Aon president Eric Andersen. By telegraphing this whole process starting way back in January of 2026, the board effectively took any transition uncertainty completely off the table for investors. Andersen joins as CEO-elect in February, works side by side with Zaffino through the spring, and officially takes the CEO spot and joins the board after June 1st. Meanwhile, Zaffino steps into the executive chair role by mid-year. Honestly, it's a textbook example of highly disciplined corporate succession planning.
And when you break down the executive compensation, you get a crystal clear picture of how highly AIG values this leadership change. Zaffino's package as chairman and CEO sat at a $25 million target. When he shifts to executive chair, that adjusts to $15 million. For Eric Andersen, well, he starts as CEO-elect with a $14 million target, which then bumps up to $18 million once he officially takes the CEO title. And just to sweeten the deal, AIG handed Andersen a cool $12.5 million restricted stock unit award simply for signing on the dotted line. It's definitely a premium price, but they are securing a highly premium executive.
Zaffino actually came out and said, "We could not have chosen a better person than Eric Andersen to steward the company's next chapter." That direct endorsement really highlights the deliberate, multi-year succession planning that went into landing Andersen, and his pedigree is totally worth mentioning here. Over nearly 3 decades at Aon, he held massive roles, eventually serving as president from 2020 through 2025. During that exact window, he helped drive global programs that rocketed the firm's market value from $35 billion all the way up to $85 billion. That right there is the exact track record of operational efficiency and shareholder return that AIG's board is tapping into.
Let's pivot to Section 3, Capital Returns and Ratings. Get this, In just the first quarter of 2026 alone, AIG returned a whopping $760 million directly to its shareholders. They went big on stock repurchases, retiring about 7 million shares to the tune of $519 million. The other $241 million went straight out as common stock dividends. In fact, they announced a cash dividend of 50 cents per common share, which is a fantastic 11% bump over their previous quarterly payout. They are actively generating excess capital and handing it right back to the investors, which is exactly what you want to see.
But crucially, they are not sacrificing their safety nets to make those payouts. As of July 2026, AIG's core insurance operations are maintaining AA ratings with a stable outlook from both S&P and Fitch, along with an A rating and a positive outlook from AM Best. Plus, their total debt-to-total adjusted capital ratio was sitting at a very healthy 17.7% at the end of Q1, so their financial foundation remains incredibly secure.
All right, finally, Section 4, Wall Street's verdict.
So how are institutional analysts digesting all this? Well, sentiment is mostly optimistic, but it's definitely a bit varied across the board. On the more conservative side of things, Barclays and Citigroup are sitting on hold ratings with targets of $80 and $88 respectively. But then you have firms like Keefe, Bruyette & Woods pointing to a $95 buy, and UBS projecting a strong buy with a $98 price target, which implies some pretty significant upside from where it's trading now. The market clearly sees the momentum, but analysts are currently weighing exactly how much of this incredible turnaround is already baked into the current stock price.
Now, what really solidifies the bull case for AIG right now is when you stack them up directly against their industry peers for this exact same quarter. While AIG watched its underwriting income triple and its adjusted ROE jump 450 basis points, some of the competition really stumbled. Arch Capital, for example, saw operating revenues drop year over year, missing consensus estimates by 6.1%. Selective Insurance reported an 11% drop in bottom-line operating income. So AIG's robust performance stands out sharply against these recent industry struggles. It goes to show that this outperformance is specific to AIG's strategy, not just a rising tide lifting all insurance boats.
So I want to leave you with this final thought to chew on for your own portfolio as we wrap up this explainer. Peter Zaffino has undeniably navigated AIG through a massive turnaround, reversing years of underwriting losses and putting the company back in a leadership position. Now, Eric Andersen takes the wheel of this highly optimized, profitable machine. The real question you have to ask yourself is this: with a fortified balance sheet, margins that are expanding, and a proven elite new CEO stepping in, is the AIG growth story entering a brand new chapter of outperformance, or is this peak execution already fully priced in by the market? Thank you so much for diving into the numbers with me today.